Hello and welcome to Options in Plain English Advanced Edition. Today we're going to look at one of the most, if not the most important concept for option traders. A thorough and deep understanding of this is necessary if you want to take your trading to a new level and go from being a trader who trades options to a true options trader. I'm talking about put-call parity. Put-call parity is the fundamental concept behind the synthetic relationships between stocks, calls, and puts that allow a great deal of flexibility when designing option strategies. These concepts will become second nature as you continue on your options trading journey and will enable you to gain new perspectives on existing and new positions, making you a more informed and more efficient options trader. Let's start by going straight to the formula. This is the put-call parity formula with no dividends, and we're going to see what all these symbols mean. The U is the underlying, which is going to be any instrument that has options. So it could be a stock, it could be a futures contract, it could be an index, it could be an interest rate product, it could be a foreign exchange product. It doesn't matter. As long as it has options, then it's an underlying. K is the strike price, which is the money that's going to be needed for either to exercise or to get assigned on a certain position, depending on whether you're long or short calls or puts. C is going to be the call, P is going to be the put, R is going to be the risk-free interest rate, and T is going to be the time to expiration. So what is this formula telling us? Well, this formula is telling us that once you have a stock, and I'm going to be talking about stocks here because this is the product that we're going to be trading the most. So this underlying is going to be representing stocks for us, okay? The stock price at any point in time is going to be equal to the strike price of the call and put that we're analyzing, plus buying a call and selling a put. So being long a call and short a put. For the time being, let's just ignore this discounting factor. We're going to go back to it in a little bit. Okay, so what does this mean? It means that if you have a stock and you know what it's trading at, and you want to evaluate the calls and puts at a certain strike price, you know that this relationship has to hold true. So, for example, if you have a stock trading at $100 and you want to evaluate the strike price at 105, and the call at 105 is trading at $1, for example, then you know that 100 is going to be equal to 105 plus the value of the call, which is going to be 1, so it's going to be 106. Okay, so if you solve for put, you move it to this side. The put is going to be equal to 106 minus, you move this one to the other side, and it's going to be a value of 106 minus 100. So you know that if it's going to be $6. So you know that if a stock price is 100, the 105 strike price is going to make and if the call is 1, then you know that the put is going to be worth $6. Okay, so this is why, and this is a very interesting property of the of the whole options world, which is that there is this basic relationship between stocks, calls, and puts. Okay, so let's analyze why we're saying that this is true, and we're going to be just evaluating this at expiration. Okay, so between today and expiration, I'm going to talk a little bit about the discounting factor here, but let's not get too distracted by it. I'm just going to explain it a little bit later. So between today and expiration, we know that the strike price is the value that you're going to have if you want to exercise or get assigned at expiration. At any time prior to expiration, the theoretical value of that strike price is going to be the present value of K at the time T, which is going to be the value at expiration discounted by the time where you are evaluating this. Okay, and using the risk-free interest rate, because this is the money that you can be that you can invest and earn a certain risk-free interest on it. Okay, but this is let's focus on the relationship between stocks, calls, and puts. Why am I saying that this relationship is true? At expiration, let's analyze this at expiration. Okay, what happens if the stock expires and it's higher than the strike price? Then you are going to be exercising your call, you're going to be paying the strike price, and you're going to get the stock price or the stock. So you're going to exercise your call, you're going to pay K, because that's the rule for the call, and then you're going to get the stock. If it expires right at the strike price, is going to be a situation where you pay K and then you get the stock. Remember, this is at expiration, okay? And then what happens if your stock expires and it's lower than the strike price? Well, in that case, you're going to be short a put, so you're going to be assigned on your put, you're going to be paying the strike price, and you're going to be getting the stock. So notice how in every situation, you're getting the stock, paying the strike price, paying the strike price, getting the stock, paying the strike price, getting the stock. Okay? So basically, having the money for the strike price and having a long call and a short put is the same thing. That's what put-call parity means. Now, the value of the strike price has to be discounted back to the time that you have between now and expiration, because this value, this money that you have to put aside, if you need $100 at expiration, you would need, let's say, 99 prior to expiration, because those 99 could be earning interest so that they become $100 at expiration. You know that the value of the strike price at expiration is going to be K, but at any time prior to it is going to be however much money you need, so that at expiration you have that amount. That's why you have to discount it back to today. And you discount it back to today by using the risk-free interest rate. Okay, so what have we learned so far? So far we've seen that the stock price is going to be equal to putting aside a little bit of money for the strike price, and then buying that call and then selling that put. In reality, of course, when you evaluate this, you don't actually have to put the money aside. You just, if you want to simulate a stock, you can just buy the call and sell the put. And you're going to be in a position where you're going to be replicating everything that happens to a stock is going to be replicated by being long a call and short a put. And we're going to see this a little bit later. But this is a very powerful formula because it allows you to see that stocks, calls, and puts are related to each other. And their value cannot deviate from in such a way that would make this relationship not hold true. Now we're going to analyze the same thing with dividends. Now, if you have a dividend, what's going to happen if you evaluate this formula, which is put-call parity, if you know that there's a dividend coming up? Well, if you know that there's a dividend coming up and you look toward the future and you know that at expiration you're going to have, for example, 2 dividend payments here, then you know that the stock, we don't know what's going to happen in terms of market or regular fluctuation in the stock, but we know that the stock for sure is going to go down by the amount of the dividend, because every time a company pays out a dividend, the value goes down by the amount of the dividend because it comes out of their coffers. Okay, so if you know that there's a dividend stream coming up, and that dividend stream can be made up of 1 or 2 or 3 or however many dividend payments, then you know that the value of the strike price, something similar to what we did with the strike price, the value of the stock price at expiration needs to be adjusted by the dividends that are going to be coming up, because they're known dividends. Okay, so we have the same elements: underlying strike price, call, put, risk-free interest rate, time to expiration, and continue. And now we have a new element here, a new factor. We know that there's going to be, for example, 2 dividend payments, and they're going to be in a month and in 4 months if we're talking about quarterly dividends. Now, if we transform those payments and then we apply the discounting factor as well, and we calculate a continuous dividend yield, then we can apply the formula using the exponential factor E in a similar way to what we do with the strike price. Okay, so in this case, the stock price adjusted by the dividends that we know are coming up is going to be equal to the strike price adjusted by the interest rate in the time that we have until expiration, plus a call minus a put, longer call and shorter put. So in a similar way that where we had today an expiration and we're evaluating what the present value of the strike price was, in this same way, we can think about a continuous dividend yield, and we'll have the stock price be the stock price multiplied by e to the minus qt, being the present value of u at time t, considering the upcoming dividends. Okay, remember, we're talking here about known dividends. If you don't know, or if it's a surprise dividend, then the formula needs to be adjusted. So anything that we know about the continuous dividend yield, and we know about the risk-free interest rate. Okay, so this formula is changing as time changes, because this factor here, time, is going to be changing. Okay, this is the time until expiration. So now that we got past the mathematical thing, how can we start converting that information into actionable information that we can use as traders? Well, let's take those concepts and kind of translate them into something that we can use. Well, if you have a stock is going to be the same thing as being long a call and short a put. But you have to adjust by the dividends and the interest rate, okay? Now, the only thing I did here is, instead of having the term u multiplied by e to the minus qt, I just got the concept of dividends, and I took this one, I solved for stock price, and then I moved the dividends over here, and then the interest rate is going to be a factor that's going to be reducing the value of k. I just took it out, and now we have the same put-call parity formula, but just in a very conceptual manner. This is a very conceptual way of looking at put-call parity. So what we have is a long stock is going to be equal to a long call and a short put, and dividends and interest rate. Okay, so if you want to replicate what a long stock position does, what you can do is just buy a call and short a put. Okay, but you're not going to be getting the dividends that you get with the long stock. That's why you have to adjust for that. And also, when you buy stock, you need to put aside a lot of money, because usually when you buy stock, you either pay it in full or you pay 50% of it if you're on margin. So this is definitely going to be more than what you get margin when you buy a call and short a put. In this case, when you buy a call, you don't get margin anything, you just pay for the call. But when you short a put, you might have a regular margin that takes the 20% of the notional value, or even less if you have portfolio margin. So this difference is reflected in the interest rate, okay? So that there is no arbitrage. Otherwise, when you could replicate the stock for cheaper and then package it and sell it somewhere else and pocket the difference. You're not, and that doesn't happen in the market. There is no arbitrage, because if there is any arbitrage opportunity, then there's going to be a lot of market makers and a lot of algos or algorithms trying to get those risk-free trades. Okay, so there is no arbitrage. So everything is going to be in line, because the market itself makes everything be in line price-wise. So another thing that's important to notice here is that you can treat this conceptual approach to put-call parity as if it was a formula. So you use you use algebra to just try to solve for any of these things, or to apply those algebraic rules to try to figure out the value of something. So in this case, for example, we know the stock is call minus put plus dividends minus interest rate. If I multiply everything by -1, then I'm going to have short stock is going to be short call, long put, and then I'm going to have to adjust by the minus dividends and plus interest rate. Okay, so short stock, if I want to replicate short stock, what I can do is short a call, buy a put, and then I'm going to have these terms be the difference between these two components. So the difference between shorting a stock and then shorting a call and buying a put is going to be the value of the dividends and the value of the interest rate. Why? Because when you're short, you have to pay out the dividends. Okay? So this is something that you don't have to do if you are using the option side of it. And by the way, this is called a synthetic short, and this is called a synthetic long. So if you ever hear someone referring to a synthetic long or a synthetic short, this is what they mean. Synthetic long is long call plus short put, being long stock, and short stock or short synthetic is going to be short call and long put. So I was saying, when you're short a stock, you have to pay out the dividend, so it affects this side of the equation. But also, when you short stock, you get money back because you're selling something and you're getting money that you can put to earn interest at the risk-free interest rate right away. So we're going to be talking about some interest that comes into your pocket, and this equation has to be adjusted for that as well. Okay, so short call and long put minus the dividends and plus the value for the interest rate is going to be equal to the short stock. So this is the first way that we can see how we can start using put-call parity in our actual trades. So if we deconstruct the formula and we get the equivalence for all of the individual elements, we're going to get what a long call, a long put, a short call, and a short put are. So if I want to replicate the value of a long call, how can I do this? Well, first of all, in this case, I'm going to be ignoring dividends and interest rates, but in reality, you shouldn't, because those are going to be the discrepancies between having one side of the equation and having the other one. Okay? So if you want to talk about a long call, how can I replicate it? Well, if I have long stock and I buy a put, I have a long call. Simple as that. So now I can see that if I want to buy a call, but I already have long stock, but I would like the profile of a long call, I just add a long put and I'm going to have now a long call. Now, if we want to talk about a short call, I want to replicate the behavior and the P&L risk profile of a short call. I just get the short stock and a short put, and it's going to be the same as a short call. Because if you think about it, putting these two together, at the strike price, you have short stock, okay? But this is going to start losing right at this point. It's going to start going down, but it's going to be offset by this portion. So at the strike price, this is going to be constant from this point and all the way to zero. That's why this is the P&L risk profile for a short call. Now, long put, you can replicate it by using short stock and long call. Okay, same thing. You have short stock. This is the P&L, and then you add a long call. What this means is that at the strike price, this is going to start giving you profits. So it's going to counteract the losses that you get with the short stock. So this starts being constant at this point, starting at the strike price. And short put is the same thing. It's going to be long stock and a short call. Now remember, we mentioned that we are ignoring dividends and interest rates, but you shouldn't, okay? So every time you replace or you think of a position and you want to replace those elements by knowing these relationships, you have to be aware of the fact that dividends and the risk-free interest rate is going to come into the picture, okay? So for example, if you have a long put, for example, okay, and you buy a long put, and on the other hand, in a different account, for example, you do a short stock and long call, they're going to be the same because the pricing of all these elements are going to already take into account the fact that with your short stock, you're going to have to pay out the dividends, okay? Same with when you have a short put and a long stock. The pricing of the put already takes into account the fact that the equivalent combination is going to give you some income here because long stock gets dividends, okay? But at the same time, long stock takes more buying power, so has less of an opportunity to earn the risk-free interest rate. So the pricing relationships, you have to be very careful, and that's why I wanted to have this lesson, because most people look at put-call parity and they get the formulas and they just start applying them. You have to understand that these formulas are the result of actually having a mathematical formula behind them, and that mathematical formula is going to have to take into account dividends and interest rates. Now let's talk about a very simple and straightforward application of these relationships, okay? When somebody tells you, okay, I am going to be selling or I'm going to be putting on a cover call, what they're telling you is I'm going to be buying stock and selling a call. Well, you can tell them that what they're doing is they're selling a put. It's the same thing. If you're buying stock at $100 and you are selling a call at 105, then that position is exactly the same as being short the 105 put. Right away, if they are not very well-versed traders, what they're going to think is that, okay, but that's not true because a short put is very risky because everybody knows that being short an option has a lot of risk. Well, you have the same risk being long stock, so it's the same thing. Okay, they can tell you, but I'm not going to get the dividend, so I prefer to be long stock. Well, yes, but when you sell your call, that call is not going to be trading for the same premium that it would be trading at if you didn't have the dividend. So this call is going to have its price depressed by the fact that there's going to be a dividend coming up. Okay, so in reality, yes, when you short a put, you're not going to get the dividend, but you're going to get a higher premium because of the dividend. Okay, so you get the same thing. Everything has to hold for the market to be in a situation where there's no arbitrage. So everything is the same. Knowing this information is going to make you a much better trader, and is going to take you from being just a trader who trades options, like I said in the beginning, to a real options trader. You're going to be able to apply these relationships, and you're going to be able to get out of trouble in some situations where, for example, you can't trade long calls, but you can trade long stocks and long puts. You can, knowing that this is equivalent, you can put on your position with different elements. So it's going to make you a very versatile trader, and it's going to make you a more efficient trader. So that's why put-call parity is one of the most important things, one of the most important concepts in options trading. Okay. Another example, if you have a position that's called what people call a merit put, which is long stock and then protected by buying a long put, you can tell that person, okay, you can just buy a call. That's the same thing. Oh, but I'm not going to get the dividend, for example. Okay, yeah, you're not going to get a dividend, but you're going to be buying a put that's more expensive than that relatively is going to be more expensive than the call. So it's the same thing. Okay, those positions are equivalent. So it's important for you to understand that that these relationships are true, and they can be applied everywhere. Now, of course, if you're talking about a long stock and a put that's out of the money, that long call is going to be in the money. So you might have liquidity issues. So you might still go for the long stock and long put, but because of liquidity. And at that point, now you are applying your information or your skills as an options trader by replacing one position with the other because of some external constraint, for example, liquidity. In this case, you know that these two are the same as this one, and you're able to replace one with the other one easily. So I hope that this information is relevant for you guys, and that you take this and incorporate it into your, not only into your option trading, but into your trading in general. It's going to make you a much better trader. It's going to make you a much better investor, even if you are not an options trader, knowing this. Because remember, some of those fund managers, if you have a mutual fund or something, they're going to tell you, oh, I have this great strategy. It's called a cover call, and it's the best thing since sliced bread. Well, you know what? Now you know, okay, you can just sell a put. It's the same situation. In your mind, it's much easier to understand what a short put is if you think about one single profit and loss profile rather than the combination of two. Okay, so I think this is very important. This is the difference between, this is going to make a difference in your trading. It's going to take you from just a regular run-of-the-mill option trader looking for some profits if the stock goes up, and then looking for some profits if the stock goes down. It's going to take you from that point to a trader who is able to deal with uncertainty in a more efficient way, and with having all the tools at your disposal when it comes to putting on positions that take advantage of your market outlook. Thank you very much for your attention, and goodbye.